Stop. Watch this closely, because what just started in silver right now has only happened a few times in modern financial history. And the last time it happened, it didn't just move silver a little, it completely reset the price structure. We are talking about a pattern that goes all the way back to 1924. And if this same structure is repeating today, then what you're seeing on your screen right now is not the rally. It's just phase one. Now, before we go any further, look at the timing. Today is Wednesday, and silver is trading right now around $79.57 per ounce. That number matters more than you think because historically, when silver sits in this exact type of zone, it doesn't stay there long. And listen, before I break this down, make sure you hit like and subscribe right now, because what you're about to see is not something you'll hear on mainstream financial media. AG John OG provides the forensic breakdown. And if you stay till the end, sis, you'll understand exactly why smart money watches this pattern quietly. Also, I want to hear from you early. Where are you watching from in the United States? And what time is it there right now? Drop it in the comments. I read everything. And I want to see how widespread this signal is reaching. And here's the real question for you. Do you think silver hitting $1,000 sounds impossible? Or does something feel off about the current price? Because once you see this pattern, your answer might change. Now let's go deeper. Back in 1924, something unusual began forming in the silver market. Not a headline, not a panic event, not even something retail investors noticed. It started quietly with accumulation. At that time, global economies were stabilizing after war disruptions, currencies were being restructured, and precious metals, especially silver, were being repositioned behind the scenes. But here's what most people don't know. Silver didn't explode immediately. It went through a phase, a slow, almost invisible tightening. Supply started getting absorbed, price stayed relatively controlled, and the public, they thought nothing was happening. Sound familiar? Because right now, we are seeing the same signals again. Let's talk about what's happening today. Data coming from US-focused institutions and exchange reports, especially from COMEX-linked inventories, show something very specific. Registered silver out the metal actually available for delivery has been under pressure. At the same time, industrial demand is not slowing down. You've got AI infrastructure, solar expansion, defense applications, all pulling silver out of the system. And yet the price still sitting under $80. That disconnect is the key. Because in 1924, the same thing happened. Demand underneath, tightening supply, but a price that didn't reflect reality yet. And when that gap finally broke, it didn't move slowly, it repriced. Now here's where it gets serious. Phase one of this pattern, the part we may already be in, is not about price spikes, it's about positioning. This is where institutions, large holders, and what many call smart money quietly build exposure. No headlines, no hype, just movement behind the curtain. And if you look closely at current market behavior, you start seeing signs of that. ETF flows have been inconsistent. Physical premiums in certain areas are staying elevated. And more importantly, there's a growing gap between paper silver and physical demand. That gap is exactly what existed before past major moves. Now I want you to think about this for a second. If silver was truly balanced, why would demand keep increasing while available deliverable supply tightens and price just sits there? That's not equilibrium, that's pressure. And pressure always resolves. In 1924, it resolved upward. Now I'm not saying history repeats exactly, but patterns, they rhyme. And what we're seeing right now is a structure that rhymes very closely with one of the most overlooked setups in silver history, which brings us to the bigger question. If this is phase one, what does phase two look like? Because historically, phase two is where the market starts reacting. That's where volatility increases. That's where price begins to test resistance levels, and that's where the public finally starts paying attention. But by then, a lot of the positioning is already done. So here's what I want to know from you, and be honest. If silver starts breaking above key levels in the coming weeks, would you see it as a real move or just another fake breakout? Drop your answer below. Because in the next part of this breakdown, we're going to connect the exact triggers that turned that 1924 setup into a full-scale price move. And when you see what caused it, you'll start looking at today's market very differently. Now let's go deeper, because this is where most people completely misread what's happening. They look at silver today, sitting around that $79, $80 range, and they assume nothing major is happening. But that's exactly the mistake that was made in the past. Because after the early build-up phase in 1924, something shifted. Not overnight, not dramatically at first, but structurally. And this is the part almost no one talks about. The trigger wasn't just demand, it wasn't just supply tightening, It was a change in how the market responded to pressure. Let me explain. In that historical cycle, silver entered a phase where price movements became unstable. Not explosive yet, but different. You started seeing faster reactions to small demand increases, sudden spikes that didn't hold, pullbacks that got bought quickly. That's not a normal market. That's a market where something underneath is starting to break. And right now, if you're paying attention, you're seeing similar behavior. Short-term moves in silver are becoming sharper. Prices react faster to news, dips don't last as long, and every pullback feels incomplete. That's not random. That's what happens when a market transitions from control to instability. And this is where phase 2 begins. Now here's the key difference between phase 1 and phase 2. Phase 1 is silent. Phase 2 starts sending signals, but the signals are confusing because the market doesn't move in a straight line. It gives false breakouts, fake drops, mixed signals. And that's exactly what traps most people because they're waiting for a clean move. But historically, clean moves come last. Let's go back again. After that quiet accumulation period in the 1920s, silver didn't just explode immediately. It started testing levels, breaking slightly higher, then pulling back, then pushing again, over and over. That repetition builds pressure, and eventually, it forces a decision. Now look at today. We're seeing something very similar forming. There are moments where silver pushes higher, then suddenly pulls back, and people say, "Oh yeah, see, it's over." But then it comes back again. That's not weakness, that's absorption. And this is where it gets even more important because during this phase, institutions are not reacting emotionally. They're watching structure, they're watching liquidity, and most importantly, they're watching who gets shaken out because phase 2 is designed to do one thing: remove weak hands. That's why you see volatility, that's why you see confusion. It's not accidental, it's part of the process. Now think about this. If silver was truly weak, why does it keep finding buyers on dips? If demand wasn't real, why does pressure keep building underneath? That contradiction is the signal. And it's the same contradiction that existed before previous major moves. Now here's something even deeper. In past cycles, including the early 20th century movements, there was a moment when the market stopped reacting normally to selling pressure. In other words, bad news stopped pushing price down, and good news started pushing it up faster than expected. That shift is one of the clearest signs that phase 2 is active. And if you look at current behavior closely, you can start to see early versions of that forming, which means we're not at the beginning anymore, we're in transition. Now, I want to bring you into this. Are you noticing how silver reacts lately? Or does it still feel like a controlled market to you? Because this question matters more than price itself. Most people focus on the number. Smart observers focus on behavior, and behavior is changing. Now here's where things start accelerating because once phase 2 reaches a certain point, you don't get gradual movement anymore. You get expansion. That's where ranges widen, daily moves get bigger, and volatility increases. And this is usually the moment when the broader public starts paying attention. But by then, the foundation is already built. And here's the part that ties directly back to your title. The reason people are talking about $1,000 silver is not because of hype. It's because when these structures fully complete, price doesn't just move, it revalues. And historically, revaluations happen much faster than people expect. But again, that doesn't start with a spike. It starts with instability, which is exactly what phase 2 represents. So now we're at a critical point because the next shift is where the market stops hiding what it's doing. That's where phase 3 begins. And phase 3 is where things get very difficult to ignore. Now this is where everything changes because once a market moves out of instability, it enters the phase that most people think they're waiting for, but almost always misread when it actually arrives. This is phase 3. And historically, this is where silver stops behaving like a quiet asset and starts behaving like a signal. Back in the post-1924 cycle, there was a moment when silver no longer moved in small reactions. It started making decisive moves, not random spikes, not weak rallies, but clean, aggressive pushes higher. And here's the key detail most people miss. Those moves didn't come with clear explanations. No headline matched the size of the move. No news justified the speed. It just started climbing. That's because by phase 3, the setup is already complete. All the accumulation, all the shakeouts, all the confusion from earlier phases, it's done. Now the market begins reflecting what was building underneath the entire time. And right now, if you're paying attention, you can see early signs of that shift because silver is no longer just sitting still. It's testing higher levels more frequently. It's holding gains better than before. And when it pulls back, it doesn't collapse. That behavior is not normal in a suppressed market. That's what happens when control starts slipping. Now think about this for a second. If phase 1 was quiet accumulation, and phase 2 was instability and shakeouts, then phase 3 is recognition. This is where the market starts waking up. Not everyone at once, but enough participants begin to notice that something is different. And when that realization spreads, price accelerates. Now here's where the historical parallel becomes extremely important. In earlier silver cycles, including the moves leading into major price expansions, there was always a moment where resistance levels stopped holding. Levels that previously rejected price again and again suddenly broke. And once they broke, they didn't act like resistance anymore. They became support. That flip is one of the clearest confirmations that phase 3 is active. And if you look at the current structure forming around the high 70s to low 80s, you can see silver pushing into zones that used to push it back down. But now, it's not reacting the same way. That tells you something. Now let's go deeper into what really drives this phase, because it's not just technical behavior, it's participation. Phase 3 is when new money starts entering the market. Not the early accumulators, not the institutional positioning from phase 1, but broader capital. Funds that were sitting on the sidelines, investors who ignored silver before, they start noticing the movement and they don't want to miss it. That's when momentum builds. And momentum is what turns a setup into a move. Now here's something critical. During this phase, the narrative begins to change. You start hearing things like, "We silver is breaking out. Something big is happening. Is this the start of a major run?" But even then, most people still underestimate the move because they're anchored to old price ranges. They think in terms of $50, $60, maybe $100. They don't think in terms of revaluation, and that's why they miss the bigger picture. Because once a market transitions fully into momentum, it doesn't move based on past expectations. It moves based on new demand meeting limited supply, and that's when things can accelerate much faster than expected. Now, let me bring this back to you because this is where your perspective matters. If silver suddenly breaks above key levels and holds, would you treat it as a real shift or assume it's just another temporary spike? Be honest, because this exact hesitation is what keeps most people from recognizing phase 3 while it's happening. Now here's where it gets even more intense, because phase 3 doesn't last forever. It builds, it accelerates, and then it transitions into something much bigger. That final phase is where price no longer moves in steps, it moves in jumps. And historically, look, that's where the most aggressive part of the move happens. That's where the conversation about extreme price levels like $500, $800, even $1,000 starts entering reality instead of speculation. But before that happens, there's one final trigger that needs to activate. And once you see that trigger, you won't need anyone to tell you what's happening anymore. Now, this is the phase most people think they're ready for. But when it actually arrives, it doesn't feel exciting at first. It feels chaotic. This is the final trigger phase. And historically, this is where everything that was building quietly suddenly becomes visible. Back in the cycles that followed the early 1920 structure, there was always a moment where the market stopped behaving like a market and started behaving like a reaction to pressure that could no longer be contained. And when that happens, price doesn't move gradually anymore, it starts jumping. Now let's be very clear here. This phase is not about slow breakouts. It's not about clean trends. It's about dislocations. That means sudden large moves in short periods, price gaps that don't get filled immediately, sharp upward pushes followed by shallow pullbacks. That's not normal behavior. That's what happens when supply and demand finally disconnect from price control mechanisms. And right now there are early signs that this kind of pressure is forming again. Let's talk about what could trigger it, because historically it's never just one thing. It's a combination. In past silver expansions, you saw tight physical supply, increasing industrial demand, monetary uncertainty, and most importantly, a loss of confidence in price stability. When those four elements align, the system starts to strain, and once it strains enough, you get a break. Now think about today's environment. Industrial demand is strong, driven by energy infrastructure, electronics, and advanced manufacturing. Supply not scaling at the same pace. At the same time, financial markets are dealing with rising debt levels, currency concerns, and shifting global trade structures. That combination is not stable, and silver sits right in the middle of it because it's not just a precious metal, it's also an industrial necessity, which means when pressure builds, it builds from both sides. Now here's where it gets very real. In previous cycles, once this trigger phase activated, the market didn't give people time to prepare. Moves became fast, unpredictable, and emotionally difficult to follow because the same people who ignored silver earlier suddenly rushed in, and that influx of attention accelerated everything. Now I want you to imagine something. If silver moves from around $80 and suddenly starts pushing into triple digits rapidly, how do you think the average investor reacts? They don't stay calm, they chase. And that chasing behavior is what creates vertical moves. Now here's the key detail that connects everything. This phase is not driven by logic alone, it's driven by realization. A moment where the market collectively understands the price we've been seeing doesn't match reality. And once that realization spreads, price has to adjust fast. Now let me bring you back to the historical parallel. In earlier silver movements, once the trigger phase activated, the move that followed was not linear, it was exponential. Meaning each move up led to a bigger move next. That's how you go from normal price ranges to numbers that previously seemed unrealistic. That's how conversations about $200, $300, $500 suddenly don't sound extreme anymore. And eventually, that's how targets like $1,000 even enter the discussion. Not because someone predicted it, but because the structure forced it. Now here's the question I want you to think about carefully. If silver suddenly enters this kind of rapid movement, would you recognize it early, or would you wait for confirmation and risk missing the biggest part of the move? Because this phase doesn't reward hesitation, it rewards awareness. Now here's what makes this even more important, because once this trigger phase fully activates, there's no going back to the old structure. The market doesn't reset to previous levels easily. It establishes a new range, a new reality. And that's where the final phase begins. The phase where everything that looked impossible before starts looking inevitable. And now, we arrive at the phase that almost no one truly believes until it's already happening. This is the revaluation phase. This is where silver stops being priced the way people are used to, and starts being priced based on what the system actually needs it to be. Not what it was worth, but what it has to be worth. Now historically, this is the part that shocks everyone, because up until this moment, people are still anchored to the past. They remember $20 silver, $30 silver, even $50 or $70 ranges, and they assume any move above that is temporary. But in a revaluation phase, price doesn't come back the way people expect. It establishes a new floor. Let's go back to the historical pattern again. After the early accumulation, after the instability, after the breakout phases, there came a point where silver simply refused to go back down. Even when it pulled back, that it held higher levels. That's how you know the revaluation is real. Not because price spikes, but because it stays elevated. Now connect that to today. If silver moves through $100 and then $150, and instead of collapsing, it starts holding those levels, like that's not a rally anymore, that's a reset. And once a reset happens, everything changes. Mining economics change, industrial cost structures change, investment behavior changes because suddenly silver is no longer cheap. It becomes strategic. Now this is where the conversation about $1,000 silver needs to be understood properly. This isn't about a straight line from $80 to $1,000. It's about stages. Each level becomes the new base for the next move. That's how revaluations work. $80 becomes $120. $120 becomes $200. $200 becomes $400. And once momentum and scarcity align fully, numbers that once sounded impossible become reference points. Now here's something critical that history shows us. During revaluation phases, there's always disbelief. Even as price rises and people keep saying, it's too high, it will crash, it's a bubble. But the market doesn't respond to those opinions. It responds to structure. And if supply remains tight and demand continues to grow, price adjusts upward to balance that. That's it. No mystery. Now, let me bring this back to you directly because this is where everything becomes personal. At what price would you finally believe that silver is in a true breakout? $100, $200, or higher? Think about that because your answer reveals where your mindset is anchored. And in markets like this, mindset determines positioning. Now here's the part most people don't want to hear. The biggest gains in a revaluation phase don't happen when everyone agrees. They happen when the majority still doubts it. That's why Phase 1 and Phase 2 exist to create that doubt, to shake confidence, to make people hesitate so that when the real move happens, fewer people are positioned for it. And that's exactly how major financial shifts have always worked. Now, let's step back and look at the full picture. We started with a historical pattern from 1924, a quiet accumulation phase, a transition into instability, a breakout into momentum, a trigger phase of rapid movement, and finally, a revaluation. And right now, based on structure, behavior, and pressure building underneath, there are strong signs that we are somewhere between early and mid-cycle. Not at the end, not even close. which means the most aggressive moves, if this pattern continues to play out, haven't happened yet. Now, I want to leave you with this because this is the question that matters more than any price target. If the system is slowly shifting and silver is part of that shift, are you watching it casually, or are you actually paying attention to what it's signaling? Drop your answer in the comments. Tell me your view on where silver is heading and whether you think this 1924 pattern is truly repeating or if this time is different. Because one thing is certain, when the market finally makes it obvious, the opportunity is no longer early. And by then, the price you're looking at won't be $79 anymore.